Hello everyone, my name is Iftikhar Ahmed. I am infrastructure researcher. I work with Aon Investment Consulting here in Canada, based in Toronto, and I work with many of our public corporate pension plans, endowment and foundations, help them build infrastructure portfolios. Primarily, I've spent most of my time researching infrastructure opportunities, funds, direct investments, and co-investments, and sometimes secondaries. Here, I want to talk about today how the infrastructure investor landscape looks like today and how it has evolved in the recent years. So infrastructure is one of the newest of all established alternative asset classes, but it's certainly one of the fastest growing asset class. And there are several reasons why is that happening. Continued search for yield, an increased demand for downside protection and lower correlated assets in the portfolio for lowering risk and de-risking strategies. All of these have contributed to the increased demand for infrastructure in the portfolio. It is the resilience they want to see in the portfolio, and it's not just a price correlation, it's the earning correlation to the broader economic scenarios. So those are the reasons why it has become really a fastest growing asset class in the portfolios for institutions. So institutional allocations to infrastructure range between as low as 3% to we've seen even higher than 15% in some cases. They've been out of their real asset bucket or a private equity bucket to coming out of fixed income or equity allocations. There's all sorts of scenarios there. What we see as an average in the institutional investor landscape in terms of allocation to infrastructure is about 6 to 7% on average. And here in Canada, I think that's a little bit higher side, maybe around 8% compared to the rest of the world, and especially in the US. So infrastructure as an asset class attracted initially large pension plans and insurance companies that really supported the asset class in about, I think, a decade back, or maybe 15 years back. And later, some other types of investors joined the asset class, I guess, in what it has become really a diverse investor base today. Those large pension plans and insurance companies continue to deploy capital into the asset class, but they have rather taken a more direct investing approach, whereby they're trying to deploy faster and also have the ability to continue holding on to the assets for the longer time period. What that means is less proceeds coming back into their portfolio because they are not necessarily realizing those assets. All of this, we believe that will eventually help them stay at their target allocations for longer time period, and they will eventually slow down a bit in their deployment. Now, I also wanted to talk about where we think that the next round of growth is coming into the asset class. What we found particularly interesting is that now in the more recent years, there's smaller and mid-sized pension plans, both public and corporate, and smaller and mid-sized endowment and foundations have actually started to allocate to the infrastructure asset class, where back in the days they thought it was not possible to implement and roll out an infrastructure program. There are different types of structures that have emerged in the infrastructure, have probably made it a little bit easier for them to implement infrastructure program. I think we all like large number of investors with average size than really fewer investors with very large size. I think it's all good for the asset class, and it's as diverse investor base we have as possible. And there are many those mid-size and smaller investors and institutions that are yet to approve allocations to infrastructure. So many of the larger pension plans and even the small and mid-sized pension plans that I referred to earlier are still behind their allocations. One interesting way of looking at that is looking at the dry powder in the market in infrastructure. So we estimate, and there's several sources to that, of course, but the estimated dry powder in infrastructure and rather in private infrastructure market is about 170 to 200 billion. what that number means to us is a very conservative estimate of the amount by which these institutions are behind their target allocations for the next couple of years. And we are working with many of our clients like that and help them, advise them get to their target allocation with the required diversification level in the portfolio.